All right. Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here with the last week in Mortgage Today, our weekly look at all the latest happenings in the wild and wacky mortgage industry. And each week, I am pleased to be joined by one of our members as my co-host to help get their thoughts into the insight of the current business climate, as well as some of the latest news headlines. And this week, I am pleased to once again be joined by Erin D., the COO of Loan People out of Austin, Texas. Erin, thanks again for joining me.
You're welcome.
And the last time you co-hosted was right before the Super Bowl. You're a big Tampa Bay Bucks fan. I remember we were talking about the Super Bowl. They ended up just whooping the Chiefs' ass. Who besides you saw that coming? Nobody.
I actually thought it was going to be a lot closer game. I thought the spread was actually pretty accurate going into it, but as the game wore on, I was happier and happier, and I'm pretty sure it's all because I got my Brady jersey this year, and I got to sport that and support the team all year. So whatever the reason, I'm happy.
And they brought everybody back, so loaded up, ready for bear. Hopefully my Browns will be their opponent in the Super Bowl next year. We're about to sign Jadeveon Clowney, it looks like. So
saw that.
Yeah, so we'll see what happens. But congrats to your Bucks, and thanks again for being the co-pilot this week.
My pleasure.
All right, as always, encourage interactivity. Any questions, comments, jokes, anything not too inappropriate, pump it into the chat or the Q&A, and we'll voice it aloud. And Erin, let's go ahead and get right into it. There is so much going on right now in the mortgage industry. Really just a lot of government and regulator intervention in the mortgage industry. A lot of it with little or next to no notice. It seems like, almost every day, pop on the blogs and the various mortgage news websites and like, oh, okay, wow. All right. That's, I didn't see that one coming, but the latest was an announcement from FHFA basically saying GSEs no longer going to buy loans under the QM patch. It looks like after July 1 of this year. The QM patch is confusing to many, including myself. From the way I understand it, it will now revert to where they won't buy loans more than 150 basis points over the APOR, which right now is about 275. So do I understand this right? That
it's actually a bit more of a gap. The way I'm reading it is that the CFPB is essentially changing QM, and instead of looking at the DTI, they're going to be looking at that APOR gap. But that final rule is not due out until October of 2021, but they're trying to push it to 2022. So what you have then is you have these gap of the loans that can't go under the GSE patch. But since they don't have a final rule for what a QM is now, you're basically have this group of loans really kind of over the 43 DTI that were covered by the patch that can't be purchased by the GSEs now because they're going to be waiting for the final rule from the CFPB. So it's just like you've got a situation where you've got two government entities kind of not working in stride, not working together, creating some confusion. Really what this is going to do is it's going to push loans, and its application date of July 1st or later. It's going to push more loans into the non-QM space. So non-QM is about to get a really big boost in business, at least until the CFPB can get their final rule together.
And it's been at least 4 or 5 years where, I've just been hearing this is the year that non-QM, finally takes off. It hasn't really happened yet. But it feels like now this will be the year with a lot of these restrictions coming in, CFPB and FHFA, and, limiting things like investment properties, second homes. We'll get more into that in a little bit here. And, non-QM loans and putting a hard cap on that DTI. So it should see a lot of the non-QM lenders start to get a little bit more aggressive in what they're promoting and what they're offering.
Yeah, they're definitely risk shedding. I think, you may also see some of those loans go towards FHA, and especially with some of the other changes about, the multiple risk layers where they're only going to purchase a certain percentage of purchase versus refis with, more than 2 of, their risk levels, the DTI, the FICO, the LTV. So what they're really doing is risk shedding, and they're risk shedding off to non-QM and really to FHA. So I think you're going to see a big push in the FHA space as well.
Yeah, and the FHA Insurance Reserve Fund is over 3 times the federally mandated level right now, has led
Mhm.
to a lot in the industry to call for a reduction for the FHA insurance premiums. A lot we're calling for a 0.25% reduction in the upfront. New HUD Secretary Marcia Fudge recently came out and said, we're not going to do that right now. And she kind of cited the unknown potential forbearance, foreclosure situation, given some of the uncertainty related to the pandemic. But I feel like that the bigger reason why they're not doing anything with the FHA insurance premiums is because the kind of unintended or maybe intended consequence of a lot of these moves is more business is going to go FHA's route.
Yeah, I can't disagree with you. I don't have any evidence to the contrary, and that's kind of what my assumption was as well.
So, which is, it's good and it's bad. I mean, we were talking about this on this show a couple of weeks ago that, the side by side of that, like cusp FHA borrower, 5, 6, 7% down, maybe a FICO score that is in that 670, 680, 690 range, side by side an agency program. In most cases, the agency program, due to the cost of the FHA insurance, the better deal for the borrower.
Yeah,
The
exactly.
mortgage lender, commissions have to be paid equal on all products now due to the commission rules that were put in a while ago. But the FHA loan more profitable for the mortgage lender. So, pushing business more the FHA route. Again, one of many things that, in theory, will take a little bit less risk off the federal government or balance risk, but maybe not the best thing for like the first time home buyer or, that cusp borrower.
Yeah, I agree. I mean, I think there's been many cases when, FHA is not as good a situation for the borrower, and this is going to push many of those borrowers down that avenue now.
You guys are based out of Austin, Texas. It's a very quickly growing market. Before, are the Austin bars, what's the music scene? Is that opening back up? What's going on down there?
So we're starting to see it opening back up. Yes, absolutely. I'm starting to see more music at venues, which is great. I'm starting to see more people out, really just kind of enjoying this beautiful Austin spring weather that we have. And so bars are reopened, the actual bars without, food service I'm seeing. So it's great. It's nice to see some semblance of normalcy headed back. I'm actually going to get my vax today later. So it's really, really, really nice to start to see people out and about and enjoying themselves again.
Awesome. And then the Austin, like the demo of a mortgage lender, you do a lot of your business in that area. There's a lot of young people in Austin? Is it a lot of FHA loans? Is it a lot of first time home buyers in that market? Or is it just a mix that is kind of commensurate with other kind of growing cities in the South?
We're definitely seeing the first-time home buyer mix, especially when you talk about people coming in from California and New York, where they were, mostly renters. We are seeing that. FHA, we really don't see a lot of that in Austin. There is some, but it's really kind of few and far. You see it more out in, San Antonio, El Paso, more outskirts areas. So, we're primarily conventional, and really jumbo is huge in Austin right now just because of where values are going.
Absolutely. This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by Lone People COO Erin D. Erin, CFPB also announcing a plan to ban foreclosures for any and all reasons until 2022, regardless of whether it's pandemic related or anything. Any thoughts on that proclamation? They have it open for comment right now.
I have thoughts. So, I think we saw it in the Biden-Obama era when they basically avoided contractual rights for bondholders of the auto industry. It's very concerning to me to see once again we're starting to see a lack of regard for contractual agreements, right? I mean, there's a lot of things that go into playing to foreclosure rights, things like that. And so this is very concerning to me. I understand that it's a very good PR move, but I think that there's a lot of downstream implications that they just don't think about, and that could really have long-term effects on our legal system.
Yeah, absolutely. I mentioned this last week on this program, but just talking that we have a servicing professionals working group that is kind of a subset of our TMC membership. A bunch of our heads of servicing that get together monthly, sometimes more or less frequently, just to talk about servicing related issues, and just a lot of, like, you talk about unintended consequences of something that, like, oh yes, no foreclosures, right? Like, it's not quite that cut and dry, right? There's a lot.
It sounds good.
Right. Sounds good. Makes for a good headline, but again, a lot of unintended things that come along with that. So In general, President Biden has really been putting a lot out there with regards to housing, both in policies and in his budget proposals, and infrastructure bill had a lot in there related to housing. I think plan to improve or rehab or build half a billion affordable housing units. Today, released the first draft of his proposed budget for 2022, which was a $1.5 trillion budget, and included a 15% increase in the HUD, the HUD budget part of that. Just in reading through some of the initial news columns on that, they don't have to have the budget finalized till October 1. Politicians beat the living hell out of these budget proposals for about 6 months leading into that. And there were some specific comments from like Marco Rubio and some other Republican lawmakers almost laughing about some of the increases proposed for things like HUD. So likely to be much different when we get towards October and towards budget season. But any thoughts in general on just some of the stuff we've saw from the Biden administration regarding the housing industry, housing market, and some of the impact it could have on our industry?
Yeah, what I've seen so far, I'm actually very concerned. It doesn't seem like there's a lack of focus on home ownership, which really hurts our communities. It seems like a lot of what I've seen is going towards rental housing. And, I'm just really concerned about that. I mean, obviously we need to have affordable housing. That's a big deal, but I would love to see more of a focus on initiatives or plans going towards focusing on home ownership, especially in, our local and minority communities. When we can focus on helping promote home ownership, that helps bring people wealth and helps, bring people up in life and have upward mobility. And so I so far haven't seen a lot that I like in terms of pushing home ownership versus renters. And I think, keeping people in a cycle of renting is not great for communities, and I'd love to see more towards home ownership.
Absolutely. In general, I'm not like the, big government guy, but I think with the mortgage industry and housing, a lot of times it makes sense. I would look at Fannie and Freddie. I think the government backstop on Fannie and Freddie has provided a lot of stability to the marketplace and has helped pull housing through some tough times. A lot of talk now about, ways that the federal government could potentially help, a couple issues that we have that are really impacting housing in America. One is inventory. There's just no homes out there. The other, you just hit on it, is affordability. With rates going up and, the credit box is still not loose by any stretch of the imagination, and home values shooting up. The barrier to home ownership is rising and rising and rising, and, preventing people from that are kind of on the fringe, first-time home buyers, from buying a home and building wealth that way. I've been talking on this show and the one I do with Rob about some ideas in and around that, and been talking one about the idea that has been bandied about in some places of potentially capital gains tax exemptions for people that own investment properties if they sell them to people that will occupy the home as a way to help put more housing stock on the market, number one. Two, in theory, it would help with the affordability issue, because a lot of investment properties are lower priced homes, and it would help, in theory, help with home values as well. Your thoughts on maybe something like that, or ways that, either the federal government or, municipalities could help some of the issues related to inventory and affordability in America?
Yeah, I mean, inventory is a real tough one, and I think there's still some areas where there's probably a lot of inventory, especially where you've got people, leaving certain states. But I love the plan of doing anything that we can creatively to try to focus on making people convert from being renters to being homeowners, because it's such an amazing, it's just a leap. It's what you do to help your growth and your financial independence and your wealth. I love the plan of the capital gains incentives. I think that's absolutely wonderful. So I would love to see more plans like that. For me, it would be great to have not as much government interference or not as much government policy towards it. I would love to just have more of a regulatory environment that promotes homeownership, that promotes being able to give responsible homes to people, that doesn't prevent, cap the number of investment properties or second homes or anything like that. I mean, I've heard both sides of that argument, but really anything that you can do to help make it so that in our communities, especially like you said, the lower priced homes, can encourage people to come in and buy and give them that option and ability to buy, I think would be awesome. I love your ideas.
I see Rob Krisman in the chat. We were jokingly calling this the Swerbinski plan on the rundown with Rob and Rich last Friday. And he says the role of the Swerbinski plan should not be underestimated. And I see Ashley Alexander from our team. It was her birthday yesterday. Happy birthday, Ashley.
Happy birthday.
Reminds me, the Servicing Professionals Working Group call is this Thursday at 2 p.m. So if you're a TMC member and your head of servicing is not involved in our Servicing Professionals Working Group, the only question would be why. It's a great little ecosystem for them to network with other servicing professionals. We also have a community first working group for community lending professionals within our lender member network, and their working group call, the next one is coming up on the 22nd here in a little over a week at 3 p.m. Eastern. So the links with more information about both of those are in the chat. So but this is the last week in mortgage today. I'm here with Erin D from Loan People, and you mentioned the cap on investment properties and second homes. Let's go there next. This has been really top of mind for all our lender members. 7% of units sold to the GSEs, more than cannot be second homes or investment properties. It's a rolling 52-week period too. So good luck trying to figure out, okay, I sold 9% this week, and 52 weeks from now that rolls off. And I mean, forgetting just the ridiculous mechanics of all this, and lenders trying to figure this out. Just have heard from a lot of our lenders that immediately did obviously runs of their pipeline. I got 8% to I got 40%, and I'm in trouble.
Yeah.
Taking a look at your pipeline at Loan People, and what did you find and how did you adjust?
Yeah, I mean, the second it came out, I ran the statistics on my pipeline, and I now have on my little BI chart a permanent chart that shows me the percentage of my pipeline by volume and unit of occupancy, so I can monitor that. We had to make immediate changes, and some of that was, hey, oh my gosh, there's gonna be a pricing change coming tomorrow. Let's convert some of our pipeline over to BE while also being respectful of our investor relationships. And then, we work with our investors and say, okay, well, if we send you X number of in primary residence loans, can we get better pricing on the investment property or second home loans? Right now, we're currently locking everything BE just to try to manage and cull our pipeline, because we were 20% second home investment property. So, we've had to cull, and we're working on it really hard. This is something that is, it's classic to me, where either the people who make these decisions, they either don't know or they don't understand the impacts that this has downstream, right? And either way, why are they the ones making the decisions then? This was a drastic, literal overnight change that significantly devalued many people's portfolios. This is not a change that your big banks are going to feel quite as harshly as your local small community lenders. Those who sell to aggregators and not directly to Fannie and Freddie. People who don't have a portfolio, this really significantly impacted them, and it had an overnight impact on the affordability of these homes for people who are out there shopping, trying to find an investment home to try to help build their income stream, have a second home for their family to go enjoy after saving for years to do that, and overnight it just made it unaffordable for many. And so it would be really nice to have a more thought out method of handling this. And I always thought that AUS was the perfect way to do that, right? They can tailor what you get a DU or LPA approve on and cull their pipeline and manage it that way, which is kind of what I thought was a smart thing to do. That's not really what happened. But right before this call, I saw the MBA's Mortgage Action Alliance. Hats off to them for getting behind this, and as usual, being there to advocate for our industry. We really appreciate them and everything that they do for us. Last year, they were huge with the refi LLPA, and now they're stepping in with the non-owner occupied issue. They just sent out a call to action. So for those of you who are mom members, please check your email and go follow that. If you're not, please, reach out to MBA and become mom members so that you can get that. And they're really doing a good job of trying to get out to our elected officials to let them know, hey, there's a smarter way to do this. And one of their things that they mentioned in the email was utilizing AUS to help slowly get us into that position. So I think there's a smart way to accomplish what they want to accomplish. And, as usual, they just knee-jerked and completely shifted the whole industry and affected profitability for many, many companies. I've already heard of one company who's gone out of business because of it.
Oh boy. I mean, yeah. Why not? You could do it through loan level price adjustments, if nothing else, or, to your point, through how the AUS, underwrites these things and approves or doesn't approve them. I mean, it wouldn't have been great, but it would have been far less intrusive to add a point extra delivery loan level price adjustment to, all the different non-owner occupied categories as a way to help regulate that. In theory, that would have led to more cash deals instead of people getting financing with higher rates and more fees, and would have probably more naturally regulated the issue if the goal is to have the government, holding less properties in mortgages that are non-owner occupied. But yeah, it's crazy. I heard an interview with, and before I go there though, I would echo your statements on the Mortgage Action Alliance through MBA. It's free. I don't even think you have to be an MBA member to be a part of it. It's very low maintenance. They send out emails to alert you of ways you can essentially, quickly send messaging to your elected officials. That is very impactful, and we need to do those things. But
Yeah.
Speaking of the MBA, their former president, Dave Stevens, I heard an interview with him a couple of days ago where he was just talking about just how shocking it is to him, all these changes that are being, pushed out into the mortgage lending market with no advance warning and really no thought nor care of how they would affect mortgage lenders, but it's seemingly more important to them, buyers of homes, first-time home buyers. People are trying to refinance during the tail end of a pandemic and lower their monthly debt obligations. He was talking about how, even, previous heads of FHA and CFPB, how he would have breakfast with them regularly. They would give him, a lot of advance warning when things like this were coming down the pike. So MBA could counsel with the members on it and begin to let the regulatory bodies know about once again, the unintended consequences of things that look good on paper. And you're not seeing any of that right now. Calabria, I think, knows he's a lame duck. I heard he's not talking to any of the heads of any of the new Biden like housing administrations or people, and he's just jamming, policy down the throats of mortgage lenders with little to no warning. So kind of crazy in climate right now in mortgage.
Yeah, I mean, I didn't learn how to play chess when I was younger, but this year I've become an expert in the game of mortgage chess.
The Queen's Gambit, yeah. So
yes, exactly.
This is the last week in mortgage today. Joined this week by Erin D, the COO of Loan People out of Austin, Texas, as my co-host. And housing values in general, they got to be crazy in Austin, right? Because it's such a growing, you see the stats nationally, like where I live in Northeast Ohio, they're up 10, 15% year over year. I mean, what's the climate like down in Austin? It's got to be kind of crazy, no?
Oh, yeah, it's similar. I saw an article that said that we're the #1 city in the nation for having home purchases go over list price, like for huge, massive amounts over list price. You see, buyers are starting to put these, passionate letters to the sellers, just trying to do an emotional appeal to get them to accept their offers because there's 70, 80. I've seen 100+ offers on homes. If you look at what's list, everything is pending basically immediately. I think we have like a half a month's worth of supply in the market. We don't see an end in sight with Tesla coming and all the other companies that are coming. It's crazy.
Really is nuts. And I have been chronicling this show. I'm renting right now. I'm looking to buy a house and there's just nothing. There was a house that was listed late last week. It was listed for $489, and I was on the market for one day. I contacted the realtor. They said there's already been 10 offers over 500,000. Like it just hit the market. So it is just crazy what is going on right now. And then the new construction market as well. I don't know how many new homes are still being constructed down in Austin, but between the price of lumber and land and the lack of skilled labor, I think we got, there's some serious roadblocks to creating new housing stock as well to provide a more long-term solution for the inventory issue.
Yeah, absolutely. And, in Austin, we're trying a lot of things, density and, redoing coding, the land codes and everything. And so there's definitely new construction. There's people building out in the outskirts, but the outskirts are getting further and further out. I think Austin to San Antonio MSA is going to be one giant MSA here in the next few years.
This is the last week in mortgage today. We've got about 5 minutes left with Erin D from Loan People. Before we go forward, just want to remind everybody, actually coming up in 35 minutes at 3 p.m. Eastern, have a really unbelievable session at the top of the hour coming up here about leadership and building a leadership program in your organizations. Really has been one of the top issues for our members. As everybody, our staffs went remote last spring, developing leaders, maintaining and creating, great company culture without having people in the same building. It's something we've just been doing a lot with our members about, discussions amongst one another. Really great program coming up at 3 p.m. Eastern, led by Keith Cantor, First Community Mortgage, really brilliant CEO of one of our member companies and a great guy that has implemented a leadership program within his company, utilizing a leadership expert. And he's going to be nice enough to kind of, open up the hood and let us know what he did, how it worked, and things he would have done different. So the link to register for that's in the chat, and would highly recommend jumping on that. Erin, last year was a huge volume year. I saw the MBA came out with the official profitability stats for independent mortgage banks was like 3 times, what it was the year prior. The volume standings are coming out. I know you guys started as a newer company, you kind of got going, right? Like right before all hell broke loose last year. So what was it like having last year be essentially the first full year of a new company? It's good, right? Because you get off the runway quick, but it had to be a little chaotic.
Yeah, it definitely was. But, we set up the company. I think being a new company actually helped us because, we didn't have all kinds of legacy processes and systems. We had initially set everybody up to be all remote. We kind of already knew that it was going to be a year of change and flux and figuring out what we had to do. So we were already in that mindset and that mentality. And, it just reinforced that we have to be flexible as leaders. We have to be able to have good data at our hands and be able to make good decisions quickly. So, it was fun. It was great. I obviously realized it's going to be really hard to beat those results from a profitability standpoint, but, it was definitely a good year, and it could have been a lot worse, and we're really thankful for it.
I saw just today, TMC preferred partner, iEmergent, released some of the top lender in America standings for last year. They're the rundown of like the top 15 lenders in America. Rocket, 313 billion at number 1. United Wholesale, 182 billion. Wells Fargo, 126. Loan Depot, Caliber, Freedom. Then you got Chase and Bank of America, Fairway, Mr. Cooper, Cross Country, Guaranteed Rate, Home Point, and Guild. The way I look at this is the last time I think we saw official market share stats, IMB versus depositor, was pretty close to 50-50, but I think independent mortgage banks, led by some of these big ones that went public over the course of the last 6 months, my guess is IMB market share 60 and probably 60%, which is, I think that's going to be the highest it's ever been. So
yeah, I agree. It's great. I love it. I'm an IMB girl, so I love to see us moving ahead.
And then, just going back and forth in what we were talking about, like the Scotsman Guide rankings with all the top originators. It kills me. One of my buddies is an idiot and made 8 times my salary last year. We all know people like that, but originators just got, you were kind of joking to people that were like 100% refi.
Yeah. Some of those are like, it's the ultimate one-hit wonder list, right? These guys that literally 0% purchase, they're not going to be on that list next year.
Put that money in the bank or invest it somewhere. Yeah, if you're one of the 100% refi people. So, coming up on the end of time here, Erin, any last thoughts, comments? How you looking at 2021? The year kind of got out of the gates quick. Obviously, volumes come down a little bit now. Rates are up, and there's no homes to buy, as we've chronicled. But how you looking at 2021 in general, and any really key strategic initiatives that Loan People has for the rest of this coming year?
Yeah, we're definitely not going to be at last year's volume. We're not going to be at last year's profitability. Just rates going up, changes to GSE guidelines. I still feel really great and really hopeful that it's still going to be a good year for us. But I think this is going to be now an opportunity for us to look back, take a breath, and say, okay, what worked, what didn't work? So really what we're doing is fine-tuning our processes. We're putting in systems where maybe the systems we had in place didn't work so well, and really just trying to refine what we do to perfect the model so that we can continue to grow in our market and in other markets, because we think we've done a great job and we have a really great value proposition for our customers and for our employees. And so now we really just want to focus on being able to expand that out.
Sounds like a good plan to me. And always enjoy the conversation on the mortgage industry with you, Erin. Thank you so much for joining me again this week.
Thanks for having me. It was always fun.
And to all our attendees, thank you for joining us. We are here every Tuesday at 2 p.m. Eastern live. And then, of course, we post this to our YouTube channel and make it into a podcast and release it that way, where I know a lot of you listen as well. We appreciate it. And keep the feedback coming on ways we can improve the show, and appreciate your attendance. With that, have a great week, everybody, and we'll see you again next week, Tuesday at 2 p.m. Eastern, with the last week of Mortgage Today. Thanks, and have a great week, everyone. Take care.